We're going to try to cover 6 main topics today. First is why a mortgage broker, mortgage lender, or other investor wants to start a fund. Why do investors want to be in the fund? How do mortgage pools or mortgage funds work? What are the business risks and challenges in starting and running a mortgage fund? What if you have any additional questions? How can you start a mortgage pool or fund? And are there alternatives if you're not ready to start one? First, why do mortgage brokers or lenders want to start a fund? First, mortgage lenders will make a lot more money than their mortgage broker or real estate professional counterparts. Mortgage brokers are typically used to getting points and fees. With a mortgage fund, not only do you get points and fees, you're going to get points and fees, you're going to get loan servicing fees, asset management fees, or some other type of additional compensation that you don't have to originate new business. You're going to get it as part of keeping the business in the portfolio itself. Furthermore, there is a lot less paperwork associated with mortgage pools. Also, mortgage pools contain a lot of disclosures, in fact more so than anything else, that they're designed to protect you, the mortgage professional. They discloses the risks associated with investing with promissory notes, bankruptcies, foreclosures, all these different risks that you may not think about when selling a loan to a private investor. Why do investors want to be a part of the fund? Well, first and most importantly, they want diversification. Investors will more than likely be earning something on their money at every given time. How many times have you heard as perhaps selling promissory notes to your private investors that they don't earn any money because some guy has defaulted on their promissory note? Instead of the $2,000 they expected in income, they got a big goose egg. With mortgage pools, what happens is that there are more than one note. There's 30, 40, 50 notes, depending on how many in the mortgage fund. It's all about diversification. If one defaults in a mortgage pool, well, instead of earning 15%, the investor may only earn 14.5%, maybe 14%. But it's a lot better than earning nothing. Also, investors like around-the-clock investing. Their money is working every second of every day in the mortgage pool. When a promissory note pays off, they're not earning anything else. They're asking you, well, when's the next deal? When's the next deal? With a mortgage pool, their money's always working, and you will invest their money in another loan immediately. Well, how do mortgage pools and mortgage funds work? Well, as you can see by the chart, there's 2 main entities. There's XYZ Fund Manager, Inc. and XYZ Mortgage Fund, LLC. The manager is really the company that you are going to own. The LLC is what your investors will own. The LLC will hire XYZ Fund Manager to be its manager. So the manager will act in the capacity as a broker to the fund, which will be basically the mortgage lender. Well, how do you earn money? Well, investors will earn money on giving you dollars to invest in the fund, and they will earn a certain return on investment. The money will be lent out to borrowers, and you as the broker will be earning points and fees. Also, as part of servicing the fund, you'll be earning either loan servicing fees, asset management fees, or some sort of compensation for originating that loan one time. Also, if you don't think the loan fits into your mortgage pool, you could broker it out to a private investor. There are 3 main types of mortgage pools. There's the typical fund, the hybrid fund, and the scratch and dent fund. With the typical fund, the investor will earn whatever the fund produces. Outside of a few servicing fees or asset management fees, the investor gets every dime. With the hybrid fund, the investor is guaranteed a certain rate of return, and the remaining part of that is given back to the manager. With a scratch and dent fund, you will have REOs or non-performing notes into the fund itself, and the manager will earn a compensation based on some sort of split between the fund and the LLC when the LLC goes to either foreclose on the properties or sells off the defaulting notes. There are 2 different types of offerings that are typically done with mortgage pools or mortgage funds. Either a federal offering under Rule 506 or a state offering. There's a little bit difference between the 2 different offerings. First, with mortgage lending, you can lend out money in all 50 states, subject of course to proper licensing. With state type offerings, you can only lend out up to 20% of your money outside of that state. Again, subject to typical licensing issues with all 50 states. With investors, you can have investors from all 50 states with your Reg D pool. With your state fund, you can only accept investors in that particular state. Advertising, there's a major difference. With state, you can generally advertise throughout the entire state for investors to invest in your fund. With federal type offering, you can do no general solicitation. That means you can't generally advertise, do radio broadcasts, or TV type ads. Also, there's a little bit different in investor qualification. With the Reg D, the investors are $200,000 of income, or $300,000 of income, or $1 million in net worth. With the state type offering, it does vary. In California, for instance, it's $65,000 of income and $250,000 in net worth, or $500,000 in net worth. With both type offerings, though, there's a limit of 500 investors per fund. No matter which one you choose, either federal or state, you could also do an international offering. Regulation S, as in SAM, is an international offering that allows mortgage pools or funds to obtain international money, basically people who aren't citizens of the United States. You raise money through the Regulation S, and also you must comply with the host country's laws. If you, for instance, want to raise money in England, you must do a Regulation S offering, as well as figure out whether you need to do a securities offering in England or not with the mortgage fund. Advertising is okay, as long as you do it outside the United States. If you're doing a Regulation D or a state offering, you can do them both as well as this Regulation S offering. The SEC has said there is no integration, so you can do them all concurrently. So both you can have a domestic as well as international offering for your mortgage fund. Also with Regulation S, there are no suitability standards as far as the United States goes. Remember that the host country may have suitability standards that you must look into. What are the business risks, challenges, and solutions in running a mortgage fund? Well, keep in mind this is a company like anything else. You have employment salaries, you have taxes, you have cash flow. All the other worries of running a company are here as well. Keep in mind also, you're also running a lending business, just like any other mortgage company. You've got to determine software, loan processing documents, origination documents, all these other different types of software. Accounting, you must get audited financials with your mortgage funds, so you're going to need an accountant to do these audited financials for you. Or you could outsource the loan servicing and the partnership to a loan servicer. Also, keep in mind about creating and keeping reserves. You're going to need operational expenses to either advance money to protect your security interest or to hire an attorney or foreclosure company to start your foreclosure process. Also, keep in mind about investor suitability. Are they suitable to even invest in your fund? Right now, of course, the stock market is in chaos, so you really need to educate your investors on alternative investments. Also, what about ERISA money? You may accept ERISA money in your mortgage fund, and if you accept self-directed money, you may accept almost 100% of ERISA money into your fund. Well, what if you're not ready for this, and you're wondering whether there are alternatives to mortgage pools? Well, there are. You could fractionalize it. By fractionalizing, what that means is you'll take one promissory note, and instead of selling it to one investor, you'll sell it to 10 or 15 investors, or even more, depending on how big the promissory note is. Keep in mind that this is a security, and you're going to need to follow the applicable securities laws in either the state or the Regulation D that we went over earlier. Girassi Law Firm has helped plenty of mortgage companies and mortgage individuals create their mortgage pools. We have done over 100 of these private placement memorandums or state offerings and created over $10 billion of total offering debt for mortgage pools. Are you ready to get started? If you are, give me a call. My name is Anthony F. Girassi. You can reach me at 949-379-2600. You can email me at anthony@girassilawfirm.com or visit us on the web, www.girassilawfirm.com.